The president, of course, blowing his own trumpet in this regard. Just how have the markets performed under Donald Trump?
Well, let's take a look, Shahan. This is the Dow Jones Industrial since he took his oath of office in January 2017. In fact, as you can see, a return of 27% over a period of around about 20 months or so. So some really strong numbers, as your previous guests have said. He certainly hasn't struggled to get the markets excited. This is an important stock market as well. This is the S&P 500. The numbers slightly more muted here, Shahan, around about 20% over that period. We are close to 2 years now since he did get elected. So a pretty strong performance. There have been some ups and downs, particularly over the last month or so. As you can see, quite a big dip towards the end of that period. But still, 20% over 20 months, not bad at all, Shahan.
Yeah, and how did things actually go under the previous presidents?
Well, we've actually been deep diving that, Shahan, and actually looking at some Republican presidents and some Democrat presidents. This was the last Republican in the White House. This, of course, is George W. Bush. And we've looked at the performance on the S&P 500. We've looked at the dips and the bumps and the troughs and smoothed it out over the term that they were in office. George W. Bush, an annualized return, Shahan, of almost negative 4%. Remember, he was in power when the September 11 attacks happened. He also took the U.S. Into war in Iraq and Afghanistan. So a difficult period for him. Of course, Ronald Reagan was a Republican. He was in power when the U.S. was going through an absolute boom. Wall Street was going crazy, really bustling with activity. Annualized return there of 15%, Shahan. But the next two, I think, might surprise a few people. Donald Trump has blamed a lot of America's problems on this man, Barack Obama. And remember, Shahan, he inherited an economy that was coming out of the global financial crisis in 2008. But if you take a look at his annualized return over the 8 years he was in office, Shahan, 16.25%. That places him second on the list in terms of performance. I bet you won't guess who came first. This man got himself in all sorts of trouble when he was president of the United States. But one thing he knew how to do was get investors excited and get them spending their money on Wall Street. 17.5% annualized return for Bill Clinton, Shahan.
I mean, you use the word performance and excitement, Michael, and you wonder how he actually had time to do that properly. Let's talk about Republicans actually having control of the House and the Senate. Some are saying it's a winning formula. Yep. Why mess with that?
Exactly, and the thing about that is, Shahan, is that U.S. voters do tend to mess around with their presidents a little bit. So what we're showing you here, Shahan, is the performance of the president's party in the House of Representatives. And what you'll see there, the blue representing a Democrat president, the red representing a Republican president, very seldom does the president actually manage to grow the number of seats in the House of Representatives. Take a look right in the end there on the right of that graph, Shahan. Barack Obama, despite doing so incredibly well in helping to grow that economy, lost 63 seats in the House of Representatives in 2010. 4 years later, again, lost 13 seats. And you see a similar pattern when it comes to the Senate, Shahan. Again, even Ronald Reagan, who, as we mentioned, did so spectacularly well. Bill Clinton did fantastically well when it came to the economy. But look at that, Shahan, losing 8 seats in the Senate. Obama in 2014 losing 9 seats, and he also lost control of the Senate. So it's almost like a handbrake that U.S. voters are really putting on their leaders during these midterms. So a strong economy, no guarantee, Shahan, that the U.S. president and his party will grow their influence in Congress.
Yeah, it's so interesting to watch. I can't wait to see the results of this. Thanks so much for that. Appreciate it, Mike.